Company analysis Tenet Healthcare Corporation, THC, on the Russell 2000. Liquidity ratios. All balance sheet numbers for valuations in millions of dollars. By Dwayne Gray, June 2nd, 2024. Liquidity ratios are used to judge company's ability to meet its short-term commitments. Quick ratio. Current assets subtract inventories divided by current liabilities. 2023. 1.4193 to 1, or $101.42. 2022, 1.2458 to 1, or $1.25. The ratio of $1.42 or $1.25 to 1, 2023-2022 means that Tenet Healthcare Corporation has $1.42 or $1.25 of current assets exclusive to inventory to meet each $1 of its current liabilities. There is no absolute standard for the quick ratio, but 1 to 1 or better suggests a good liquidity position, meaning it can be converted about 50 cents more than its cost of debt to cash easily. Asset analyst ratio. Tangible assets subtract current liabilities, subtract short-term debt or accrued interest payable, divided by total debt outstanding or total liabilities. 2023 equals 1.0240 or 2022 equals 0.9964. The ratio of 1.02 or 0.99 to 1 means that Tenet Healthcare Corporation, for example, has 1,024 or 996 2023 and 2022 in NTA for each 1,000 of total debt outstanding. This asset value behind each 1,000 of total debt outstanding is important information for debt holders. Normally, they have claim against all of the company assets after providing for liability items which rank ahead of their claims. To be conservative, goodwill and other intangible assets are first deducted from the total asset figure. In our example, Tenet Healthcare Corporation has 1,024 or 996 of assets backing for each 1,000 of total debt outstanding after providing for current liabilities. Short-term borrowings and the current portion of long-term debt are excluded from current liabilities, but they all are included in total debt outstanding. If the industry standard for this ratio in the retail companies should be at least 2,000 of NTA for each 1,000 total debt outstanding to meet companies, in fact, exceeds this standard. Industry standards for this ratio vary due to the parts of sustainability of income provided by the company's utilities. For example, for a fairly stable source of income and greater assurance of income continuity compared to retail stores, there are characterized as heavy investments in permanent property and account for a large number of their total assets. They are also subject to regulation and ensure that utilities are fair return on its investment. The number of tenants are not promising and leave room for improvement. Ratio analysis, risk analysis ratios. How well companies deal with its debt obligation. Debt to equity ratio. Total debt outstanding divided by equity. Short-term borrowing plus current portion of long-term debt plus long-term debt divided by total equity equals 1.6298, 2023, or 2022, 1.9658. Debt to equity ratio. The debt to equity ratio is often expressed as a percentage of debt to equity. In the example above, the total amount of debt represents 162.98 2023 or 196.58 2022 of the size of the total amount of equity. The ratio is 1.6298 to 1 2023 or 1.9658 to 1 2022. It is above or high for Tenet Healthcare Corporation. If the ratio is too high, it may indicate the company has borrowed excessively, which increases its financial risk. If the debt burden is too large, it reduces the margin of safety protecting the debit holder's capital, increase to companies' fixed charge, and reduce earnings available for dividends. In times of recession or high interest rates, high debt burdens could cause financial crisis for the company. Cash flow to total debt outstanding. Cash flow from operating activities divided by total debt outstanding debt. Operating income plus depreciation, subtract equity from earnings of unconsolidated affiliates plus working capital divided by short-term borrowing plus current portion of long-term debt plus long-term debt. Net working capital equals current assets divided by current liabilities is equal to 2023 equals 1.1366. 2022 equals 0.9683. Cash flow to total debt outstanding ratio. Cash flow from operating activities is a measure of a company's ability to generate funds internally. One thing being equal, a company with a large and increasing cash flow is better able to finance expansion or using its own funds without need to issuing new securities. The increased interest of dividends costs of new securities issues may reduce cash flow and earnings. An issue of convertible or warrants may dilute the value of common stock. The cash flow to debt outstanding ratio gauges a company's ability to repay the funds it has borrowed. Short-term borrowing must normally be repaid and rolled over within a year. Corporate debt issues companies have sinking funds require annual cash outlays. A company's cash flow from operating activities can therefore be adequately can be adequate to meet their commitments. Before calculating this ratio, it is important.